Good morning. Welcome to the News Hub. I'm Rolf Winkler. The monthly jobs report is in just now. The unemployment rate goes to 7.9%, which is what economists expected. Non-farm payrolls increased to 171,000. That's pretty much well above where they expected, coming in at 125,000, not 171. Wall Street Journal economics reporter Sudeep Reddy is joining us with fast reaction. Sudeep, better than expected? What's your fast reaction?
Absolutely. It's much better than expected, and it shows that the trend of improvement in the labor market is continuing and might be picking up just a tiny bit. There have been a lot of worries that some of the fears about the election and the fiscal cliff might hold back hiring, but it looks like we are back to a modest trend of improvement in the labor market. The unemployment rate jumping 0.1% to 7.9% is not a huge surprise given how steeply it dropped last month in the report, which a lot of people thought to be a little too much for a single month. And so overall, this just confirms that we're seeing a rather slow but still steady improvement in the labor market.
Okay. Sudeep, stay with us. I want to bring in Doug Roberts, who is the Chief Investment Strategist for Channel Capital Research. Doug, good morning.
Good morning. How are you?
I'm good. Thanks for joining us. Quickly, now, the backdrop to all of this is the Federal Reserve has said they've got an open-ended bond buying program, and it's going to continue, well, it's open-ended. What is this jobs report? How does it impact that?
Really not too much, because the Chairman Bernanke has said that even if there's some strengthening, he's going to continue, basically his program of quantitative easing, until he sees that becoming sustained strength in the economy. This is really only the first report, and it actually reverses a negative report last. So it doesn't really, unless we get, let's say, 6-7 months, and he's almost said it could be as much as a year, he's not going to even consider basically changing his monetary policy. So I think this is really status quo in terms of this, but it might benefit just in terms of an improvement in the economy and investor sentiment.
Okay, Doug, stay with us. I want to bring in Phil Izzo, the editor of the Real-Time Economics blog for the Journal. Phil, what's the story behind the headline numbers?
Hey, Ralph, this looks pretty good. Even that jump in the unemployment rate, there were more unemployed people than there were last month, but there were a lot more employed people. One of the reasons that it increased is that a bunch of people came back into the labor force, and that's good news. It means people are starting to feel a little bit more confident. They want to search for work again. So it looks like even that jump in the unemployment rate, it didn't rise very much, just 0.1 percentage point, still under 8%, and it looks like it rose for good reasons instead of bad reasons. And then the job gains of 171,000 is pretty good. It's it's above the level that we see to bring down the unemployment rate. It was pretty widespread throughout the economy. Most of the jobs obviously in the service producing. So overall, this is a pretty good report.
Okay, you said most of the jobs in service producing. Is there, in terms of industries that are driving this jobs growth? I mean, this number is now at least a little bit higher than what is needed to effectively absorb new workers coming into the labor force. So you're actually starting to, it's better than kind of stagnant,
right,
if you will. What are the industries that are really driving that?
Well, it looks like some of the industries are still, we thought we would see a bit of a rebound in construction, and those are still falling. But it seems like the service sector is really the sector that seems to be driving things much more than manufacturing. We've seen some weakness in manufacturing numbers recently. I believe in this report there was a bit of an increase, but there's been, with weakness overseas, there's been some difficulties in the manufacturing sector. One area for caveats also is the average weekly earnings were basically flat, and hours were basically flat. So, I mean, that's not terrible news. I mean, they didn't really drop. But the fact that we're not seeing gains in earnings does, sort of hold back consumer spending in a way.
Okay, Sudeep, let's come back to you. So, this a benefit for President Obama ahead of the election, or is it too late to have an impact on undecided voters?
This confirms for President Obama the case that he's been making, that even though the improvement in the economy and in the labor market has been somewhat disappointing and relatively slow, it has been steady. And so what he's been able to accomplish is this argument that if you continue with me, then we'll move on this path. Mitt Romney's argument, of course, is that this isn't fast enough and this isn't good enough in terms of improvement in the labor market. So he's trying to make the case that we could have much better, much faster growth in the labor market and jobs if you were to go with him. What's interesting in this data is how much the trend seems to have improved in prior months as well. The revisions to prior months were fairly solid, with both the September figure and the August figures being revised upward. And so that's a fairly good sign that we're coming, we're strengthening. And if the unemployment were to rise with payroll numbers that good in the coming months, that wouldn't necessarily be a bad sign, because it could mean that people are coming back into the labor force when they see the improvement. And so all around, this seems to be a good trend if it can be sustained with all the threats such as the fiscal cliff on the horizon.
Okay, you mentioned Mitt Romney. Speaking of Mitt Romney, Doug Roberts, what is really the calculus here for his? Let's just assume for a moment that he gets elected. How does this jobs report impact, say, the kind of Fed policy he would seek to promote as president?
Initially, if you look at his advisors, some of them aren't really as negative on Ben Bernanke's policies as he is publicly. So, given that they were the most likely people that he would appoint in these positions, I don't think it's going to really change substantially. The negative that I will be is until you really know who's going to be in there, what his policy will be, it can add a substantial amount of uncertainty to the markets, and markets hate uncertainty, and that could really have more of a negative impact than the actual change in policy.
Mm-hmm. And you've got the fiscal cliff looming on the horizon, though. Personally, they'll probably come to some agreement to prevent that. Phil, I want to jump back to you quickly. So. But now, there was a lot of controversy after the last jobs report. Remember, Jack Welch put out that infamous tweet and he's basically suggesting there was kind of a conspiracy behind the unemployment number. And yet, he struck a little bit of a chord where you've got two different surveys. You've got the household survey, which deals with, of course, the unemployment rate, and the establishment survey, which deals with job growth. And there's some conflict in between these two. What does this report tell you about, let's say, the robustness of these two surveys?
Well, one of the interesting things about that is we see over the long term that those two numbers start to go in tandem. They trend in the same direction. And there's a lot of volatility from month to month. And one of the big objections that Jack Welch had was that there's no way that the unemployment rate could have dropped that much because we haven't added that many jobs. Because if you looked at the establishment survey over the past couple of months, there was a smaller number of jobs added. But look at this month, and you see revisions to the prior couple of months revised up, so almost 200,000 jobs created last month from what we originally thought, and that basically shows that job creation was better than we thought, which helps explain why the unemployment rate dropped as much as it did. And even this drop in even this increase in the unemployment rate doesn't make much sense with the addition of jobs we had today. But when you take the two things together, and you look deeper into the details, they do make sense together. Like I said, when that unemployment rate rose, it's not for the wrong reasons, for the right reasons, because people are coming back in to the labor force. And we look at this broader unemployment rate too. We call it the U6. It basically includes people who are discouraged and people who are part-time but want full-time work. That rate actually fell this month as the number of people who are part-time but want full-time work dropped. So that means that either those people dropped out of the labor force, which isn't likely because the labor force drew, or those people found that full-time work they were looking for.